That noise, the closing bell at the New York Stock Exchange, capping off another interesting day there on Wall Street. You know, we thought that for a while it would be pretty good news, but the Dow is down by about 500 points. This is around a 1,000-point swing from earlier in the afternoon.
That's right. It's almost like a mesa there, sitting out in the desert with that peak, and then it dropped right back. The S&P down by about 2.25%, while the Nasdaq is down by 3%. Investors, of course, reacting to the announcement from the Fed to raise interest rates by 75 basis points, or 0.75 of a percentage point. So what's going on here? Let's bring in Edward Moya, senior market analyst for Oanda, to digest all of this. Ed, great to have you with us. As we mentioned, you know, that brief green moment of like a green mesa, as I've described it, took place after the Fed announced its hike, but all those gains were lost. Why do you think that is?
Well, thank you for having me. And yes, we had quite the reaction. I think once the press conference started, Fed Chair Powell was very hawkish. He pretty much signaled that the Fed is going to remain data dependent, and until we're really, comfortably seeing inflation decline, they're going to be fairly aggressive here with tightening policy. And I think that the markets were getting a little premature in expecting them to pause these rate hikes. And it seems that we're going to be, living by each inflation and labor market report until we can really get a firm handle on whether or not the Fed can downshift to a slower pace of tightening. And right now, most of the indications are that you're probably going to still, see a strong argument made for them to remain aggressive with rate hikes. And that's never good news for risky assets.
Yeah, we did hear from Fed Chairman Jerome Powell, and he signaled that this 75 basis points, though this is the fourth consecutive time that we've seen that's not necessarily going to be what we see in the future. Let's listen to what he had to say.
At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that.
So if that's what we should attribute that downward spike to in the markets, do you expect that we'll see less volatility moving forward now that we have a better sense of the Fed's mindset?
I think right now, the markets, did we really learn anything new today? Not so much. I think there was a lot of hope growing that you were going to see that a clear downshift. It was going to be on the table for December. And I think now, investors, they're just going to have to wait. Will they have a slower pace in December, or will it come in February? I think there's, high confidence that it'll be in one of those two meetings. So we're getting close to the end of pricey and peak Fed tightness. But, still, I think what we're realizing is the terminal rate's going to be a little bit higher than we anticipated. And that's why we probably saw stocks sell off throughout the latter part of the conference.
So it sounds like this is, in a way, our new normal. These gradual interest rate hikes are kind of the economy in certain...
Not so gradual, though.
Well, it is a big jump.
Yeah.
There are pieces of... Did we lose our guest? I don't know where he went. I can't see him anymore. But I guess
I'm still here.
Okay, sorry, I can't see you. I'm a visual person. I guess what the essence of my question is: do you feel that we may not have seen the full impact of inflation, or even the connection between the rate hikes on inflation yet?
Well, that's the problem. For the economy to start to feel the impact of these rate hikes, it takes several months. So we're probably only feeling the beginnings of those rate hikes. So maybe just the first 75 basis point rate increase. So I think we're really going to start to notice the economy slowing down, I think, a lot more in the first quarter of next year. But the big question mark is inflation going to steadily be coming down? And some of those factors are going to be determined on commodity prices, and that could mean it'll depend on the war in Ukraine. It could depend on China's reopening. So there's a lot of other factors that will really determine what happens with inflation. So the Fed is hoping they can deliver a soft landing. That seems very unlikely right now, and I think you're probably going to see investors, they're eventually going to, once the market has fully priced in, whether it's 5% or 5.25%, where the Fed takes interest rates, that's when they'll start to become a little bit more constructive with getting back into stocks aggressively. But I think the risks that they might have to go higher are still on the table. So that's why we're going to probably see volatile markets for the next couple of quarters.
And no, Lana makes a good point in that the rate has actually jumped quite dramatically when you think about it in just this year.
Right. When you look at it all together, it's 75 basis points here and there and there and there, and it really does all add up.
And now, Ed, you're saying we're probably only just feeling now in the economy some of the first rate hike
interest. Which is really
interest.
concerning.
So,
actually.
oh boy, very
right.
sobering stuff.
Edward Moya, thank you.
Thank you, Ed.
Thank you.